Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Economic Indicators for Smarter Investing. How to read economic indicators for smarter investing. Investing can seem like a maze, but economic indicators are your compass. They tell you where the economy is headed and help you make smarter choices. From GDP to unemployment rates, these key stats offer insights that can shape your portfolio's success. Knowing what to look for and how to interpret these numbers can mean the difference between gains and losses. This video will break down the most vital economic indicators and show you how to use them to your advantage. Get ready to decode the financial markets and invest with confidence. What are economic indicators? Economic indicators are essential tools for investors and anyone interested in understanding the economy. These indicators help you gauge the economy's overall health and predict future movements. By keeping an eye on these statistics, you can make smarter investment decisions and avoid pitfalls. Definition and importance. Economic indicators are statistics that reflect the economic performance of a country. They include data like GDP, unemployment rates, and inflation. These numbers tell investors how the economy is doing and what might happen next. For instance, if unemployment is rising, it might signal economic trouble ahead. Conversely, a booming GDP often suggests a strong economy. Why do these numbers matter to investors? They offer a clearer picture of the economic environment. If you know the state of the economy, you can make better choices about where to put your money. For example, a rising GDP might encourage you to invest in growth stocks, while high unemployment might lead you to more conservative choices. Types of economic indicators. Economic indicators come in 3 main types: leading, lagging, and coincident. Each type has its own unique role in economic analysis. Leading indicators. These indicators predict future economic activities. They change before the economy starts to follow a particular trend. Examples include stock market returns, consumer confidence index, new jobless claims. Lagging indicators. These indicators reflect the economy's past performance. They change after the economy has already begun to follow a trend. Examples include unemployment rate, corporate profits, consumer price index, CPI. Coincident indicators. They move simultaneously with economic trends. These indicators provide real-time data on the economy's current state. Examples include GDP, employment levels, retail sales. Understanding these types of economic indicators can help you navigate the financial world more effectively. Each type provides a different perspective, whether it's predicting where the economy is headed, confirming current conditions, or reflecting past performance. By combining insights from all 3, you get a fuller picture, allowing you to make informed investment decisions. Key economic indicators to watch. Keeping an eye on economic indicators is crucial for making informed investment decisions. These indicators give you a snapshot of the economy's health and future direction. Below are some essential economic indicators that every investor should understand and monitor. Gross domestic product, GDP. Gross domestic product, GDP, measures the total value of goods and services produced within a country over a specific period, usually a year or a quarter. It's calculated by adding up consumer spending, business investment, government spending, and net exports. Exports minus imports. Formula: GDP x CIRSGXM. C. Consumer spending. I. Business investment or government spending. M. Net exports. Exports minus imports. Significance in economic analysis. Economic health. A rising GDP indicates a growing economy, while a falling GDP may signal economic trouble. Investment decisions. Investors use GDP trends to decide whether to invest in growth stocks or more conservative assets. For example, a booming GDP might encourage investment in growth-oriented sectors like tech and consumer discretionary. Unemployment rate. Unemployment rate represents the percentage of the labor force that is unemployed and actively seeking employment. It's calculated by dividing the number of unemployed individuals by the total labor force and multiplying by 100. Formula: unemployment rate = unemployed labor force x 100. Impact on the economy. Consumer spending. High unemployment can lead to reduced consumer spending, which can slow down the economy. Influence on investments. A high unemployment rate might prompt investors to opt for safer assets like bonds or dividend-paying stocks. Inflation rate. Inflation rate measures the rate at which the general price level of goods and services is rising, and subsequently, the purchasing power of currency is falling. It's typically measured by the Consumer Price Index, CPI, or the Producer Price Index, PPI. CPI formula, inflation rate, ACE, CPI this year, CPI last year, CPI last year, x 100. Effects on investments. Purchasing power. High inflation erodes purchasing power, making money less valuable over time. Asset choices. During high inflation, investors often look for assets that can beat inflation, such as real estate, commodities, or stocks in sectors like energy. Consumer Confidence Index, CCI. Consumer Confidence Index, CCI, measures how optimistic or pessimistic consumers are regarding their expected financial situation. The index is based on a monthly survey that asks consumers about their views on current and future economic conditions. Importance in predicting economic trends. Consumer spending. High consumer confidence usually translates to more spending, which drives economic growth. Economic forecasts. Investors use the CCI to gauge future economic performance and adjust their portfolios accordingly. Interest rates. Interest rates are the cost of borrowing money. Central banks, like the Federal Reserve in the US, set benchmark rates that influence all other interest rates in the economy, including those for mortgages, car loans, and savings accounts. Impact on assets and investment strategies. Cost of borrowing. Higher interest rates increase the cost of borrowing, which can slow down business investment and consumer spending. Investment choices. When interest rates are high, fixed income securities like bonds become more attractive. Conversely, low rates often push investors towards stocks and real estate. Monitoring these key economic indicators can help you navigate the financial markets with greater confidence. By understanding what each indicator represents and how it affects the economy, you can make more informed investment decisions. How to use economic indicators in investing. Understanding how to use economic indicators can be a game changer for your investment strategy. These indicators offer valuable clues about where the economy might be headed and how different sectors could perform. Here's how you can use them to make smarter investment decisions. Analyzing trends. To predict market movements, it's crucial to analyze trends in economic indicators. Here's how you can do it. Look for patterns. Track changes in key indicators like GDP, unemployment rates, and inflation over time. Are they rising or falling? For instance, if GDP has been steadily increasing, it might signal economic growth and an optimistic market. Compare against historical data. Historical data can offer context. Compare current data with previous years to see if there's a consistent trend. Stay updated. Economic conditions can change rapidly. Regularly check updates from reliable sources like government reports and trusted financial news outlets. By keeping an eye on these trends, you can better anticipate market directions and make informed investment choices. Timing the market. Using economic indicators can help you time your investments more effectively. Here are a few strategies to consider. Buy low, sell high. Economic downturns sometimes present buying opportunities. If an indicator like the unemployment rate suddenly spikes, stock prices might drop, allowing you to buy undervalued assets. Watch leading indicators. Pay attention to leading indicators such as stock market returns and new jobless claims. These often move before the broader economy does. React to lagging indicators. Lagging indicators like corporate profits and the unemployment rate confirm trends already in motion. They can provide additional assurance that the market trend will continue. Timing the market is challenging, but economic indicators give you a better shot at making smart moves. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.